Jan, good to see you.
Good to see you. Hello.
I wonder how you think the Fed is weighing, obviously, what wages are doing here, running at the fastest clip in a generation, and more than 1 million people coming back into the labor force.
I mean, I think the wage number is probably the most important, especially on the back of strong wage news also in the employment cost index a week ago. The headline number was a little bit softer there, but actually underneath the surface, that was also a very strong report. So I think there's increasing evidence that we're accelerating to levels that ultimately aren't really consistent with 2% inflation if they are sustained. Now, we don't know whether they're going to be sustained or how much of a one-off perhaps is in some of these numbers in late 2021, early 2022. But I do think it speaks to the idea that the Fed, will want to get going and deliver a series of hikes.
Yeah, I think it was Bullard a couple of days ago said that 5 for the year was not a bad bet, in his words, but that he didn't see how 50 basis points helped them out. Do you think that calculus has changed?
No, that would be my view as well. Five hikes this year, I think, seems like a reasonable number. Obviously, it's going to depend on, what the numbers say and what financial conditions do. But that is our expectation. 50 basis points, I think the hurdle for that is quite high. And I don't think that's likely, especially at the lead-off. The thing to remember also about 50 basis point hikes is that they were pretty common at times in the past when the Fed didn't have tools to communicate about the whole path of hikes. Now they have a summary of economic projections, a dot plot, where they can indicate more hiking down the road. And I think that reduces the need for being very aggressive at the meeting in the middle of March.
Jan, it's Morgan. I mean, the fact that we did see such strong job gains, and not only for January when everybody thought Omicron was going to have a much bigger impact, but also the upward revisions we saw at the end of last year. The fact that we saw this nice pop in the labor force participation rate as well. Is there read-through to be had to the end of stimulus and the fact that some of those checks that were going out directly to people's bank accounts, including things like the child care tax credit ending, had something to do with this?
Well, I think you have to be a little bit careful with the month-to-month changes in the household survey because they made some changes, the annual changes to the population weights. So those data have to be taken with a grain of salt. With that said, we have seen some improvement, I think, in labor force participation in general. And we, I think, do have some evidence that people might be coming back into the workforce. One other interesting observation is that the pace of wage growth, while generally very strong, has actually softened somewhat in leisure and hospitality, sort of post the expiration of the unemployment benefits on Labor Day. You have seen a deceleration there from extremely rapid growth rates to slower growth rates. And to me, that sort of says that, these kinds of policy changes do have effects on how people behave.